A Roman citizen walks through the forum and hears a rumor. A government contract in a distant province is making investors rich. Within hours, people are scrambling to buy ownership stakes. Prices rise, speculation spreads, fortunes are made and lost. This sounds like Wall Street, but it happened more than 2,000 years ago. The surprising truth is that ancient Rome may have created something remarkably similar to the modern stock market centuries before most people think it existed. And the story behind it reveals one of the most powerful wealth lessons in history. To understand how this happened, we need to travel back to the height of Roman power. Rome wasn't just the most powerful city in the world. It was the center of a massive economic machine. Its roads stretched across continents, its ships crossed dangerous seas, its merchants traded goods worth fortunes. Every day, gold, silver, grain, wine, spices, and luxury products flowed through the empire. We often imagine ancient Rome as a world of soldiers and emperors, but behind the scenes, something else was happening, an explosion of business. As Rome expanded, new opportunities appeared everywhere. Mines needed funding. Roads needed construction. Ports needed maintenance. Armies needed supplies. Tax systems needed management. The empire was growing so quickly that the demand for capital became enormous. At first, wealthy merchants financed these opportunities themselves. A trader might spend his entire fortune buying a ship and filling it with cargo. If the voyage succeeded, he became richer. If the ship sank, he lost everything. The risks were enormous. One storm could destroy years of hard work. One pirate attack could wipe out an entire fortune. Most people were unwilling to gamble everything on a single venture. Then Romans discovered a better way. Instead of one investor taking all the risk, several investors could pool their money together. Each person would own a portion of the venture. If profits were earned, everyone shared the rewards. If losses occurred, everyone shared the pain. It sounds simple, but this idea would change wealth creation forever. Soon, these partnerships became larger and larger. Some businesses began handling government contracts worth incredible sums of money. These enterprises became known as the publicani. The publicani collected taxes, managed infrastructure projects, operated mines, and supplied Roman armies stationed across the empire. They became some of the most powerful organizations in the ancient world. And because these enterprises were so large, ownership could be divided among many investors. For the first time, people realized something extraordinary. You didn't need to operate the business. You only needed to own part of it. That single realization changed everything. For most of human history, people earned money through labor. They worked. They earned income. They stopped working. The income stopped. But ownership created a completely different path. Now a Roman citizen could invest money into an enterprise and potentially earn profits generated by thousands of workers he would never meet. Think about how revolutionary that idea was. A person could become wealthier without personally performing more work. The wealthy Romans quickly understood the power of this concept. One investor we'll call Lucius became fascinated by it. Every morning he walked through the forum, listening to conversations. News mattered. Information mattered. Because information could affect the value of an enterprise overnight. A successful mining operation in Spain could make investors richer. A failed tax contract in a distant province could destroy confidence. Rumors spread quickly, investors reacted quickly, and prices moved quickly. The more Lucius watched, the more he noticed something interesting. The crowd was emotional. When people heard good news, they rushed to buy. When they heard bad news, they rushed to sell. Fear spread through the forum. Excitement spread through the forum. Greed spread through the forum. Human behavior looked remarkably similar to modern financial markets. That's because technology changes much faster than human nature. The same emotions that influence investors today existed in ancient Rome. Fear, greed, hope, panic, confidence. The tools changed. Human psychology did not. As years passed, the wealthiest Romans continued accumulating assets. They purchased ships, warehouses, agricultural estates, mining operations, business ownership stakes. Every asset produced income. That income purchased additional assets. Those assets generated even more income. A cycle of wealth creation emerged. And this cycle became the foundation of some of Rome's greatest fortunes. The smartest investors eventually realized that labor alone had limits. There are only so many hours in a day. But assets can work continuously. A ship can generate profits while its owner sleeps. A warehouse can earn income without its owner lifting a finger. A business can create value through the efforts of hundreds or thousands of workers. Ownership created leverage, and leverage accelerated wealth. But as always, success attracted speculation. Soon, people weren't investing because they understood businesses. They were investing because they saw others getting rich. Money flooded into opportunities that many investors barely understood. Rumors became more valuable than facts. Confidence became more powerful than logic. And like every financial boom in history, many people became convinced that prosperity would continue forever. It didn't. Some ventures failed. Some contracts disappointed. Some investors lost everything. Fortunes that took decades to build disappeared in a matter of months. The crowd learned a painful lesson. The same lesson investors continue learning today. Following excitement is easy. Understanding value is difficult. The people who survived weren't always the luckiest. They were usually the most disciplined. They understood what they owned. They understood risk. And they understood that protecting wealth was just as important as creating it. The Roman Empire eventually fell. Its institutions vanished. Its rulers became history. But the financial lessons it discovered survived. Today, billions of people invest in businesses they never visit. They own shares in companies run by people they have never met. They earn profits generated by assets they do not personally manage. Most people think these ideas are modern. They are not. Their roots stretch back thousands of years into the ancient world. The Romans accidentally discovered one of the most powerful principles in wealth creation: the difference between working for money and owning things that produce money. That lesson transformed fortunes 2,000 years ago, and it continues transforming fortunes today. Empires rise and fall, currencies come and go, technology evolves, but one principle remains timeless. The greatest fortunes are rarely built by labor alone. They are built through ownership. And that's why the story of Rome's forgotten stock market is not really about history. It's about a wealth lesson that has survived every generation since.